Have you ever looked at a number so genuinely gigantic that it just completely breaks your brain? Seriously. I've been digging into the mechanics behind what is, without a doubt, the most anticipated financial event in history, the SpaceX initial public offering. And honestly, the more you look under the hood, the more absolutely fascinating it gets. In today's explainer, we are going to look way past all that breathless media frenzy. We're doing a deep dive together because we really need to understand the actual machinery of this offering. We're talking the unprecedented hype, the hidden risks, and the jaw-dropping reality of a company that is quite literally trying to build a railroad to space.
$2.1 trillion. I mean, wow, that was the day one market capitalization for SpaceX. To really put the sheer absurdity of this into perspective, they raised $75 billion in this IPO. Just to be clear, that is more capital raised than the massive IPOs of Alibaba, Meta, and Saudi Aramco combined. It makes this the largest initial public offering in the history of global finance, beating the next largest by a massive, almost unimaginable margin. The absolute volume of capital flowing into a single entity on a single day, it's totally unprecedented. Investors were essentially climbing over each other just to get a piece of the action.
And you know, the ripple effects of that insane demand are just absolutely fascinating to trace. SpaceX priced its debut at an already eye-watering $135 a share, but within the very first hour of trading, it rocketed right up into the 160s. That record-shattering debut did two incredibly historic things. First, it instantly minted over 4,000 new employee millionaires, quite literally overnight. And we aren't just talking about senior engineers and executives in corner offices here. Because early-stage SpaceX had to preserve crucial cash for research and development, they historically compensated their workers heavily with equity to build up that high-risk startup culture. So we are talking about welders, cafeteria staff, cooks, suddenly holding life-changing wealth. And second, it pushed founder Elon Musk's personal net worth past $1.1 trillion, officially making him the world's very first trillionaire. No big deal, right?
All right, moving into Section 1, the biggest IPO in history. Let's figure out how this happened. So how exactly did a single, formerly private company reach this astronomical pinnacle? Well, to understand the math, we really have to understand the mythos. SpaceX didn't just break the traditional rules of going public, they spent 2 decades ripping up and rewriting the entire rulebook on aerospace engineering, building this incredible aura of invincibility. Let's take a quick look back. In 2008, they were the first private company to put a liquid fuel rocket into orbit. In 2015, they achieved the seemingly impossible by landing a propulsive booster upright. Think about that. That completely changed the economics of spaceflight. Instead of throwing away a multi-million-dollar vehicle every single launch, you just reuse it. By 2020, they were ferrying astronauts to orbit. And then, in 2024, I still can't believe this one, they literally caught a returning orbital-class rocket booster with giant mechanical chopsticks at the launch pad. I mean, catching that booster means they can theoretically relaunch the exact same rocket within hours. That completely shatters traditional aerospace economics. This track record of turning impossible science fiction into routine reality built the company's legendary status, and, in the eyes of the market, completely justified the massive pre-IPO hype.
Section 2. 3 engines of growth.
Okay, let's dive into this, because if you pull back the curtain on the underlying business, you're going to find something that might really surprise you. SpaceX isn't actually just a rocket company. I know, that's the public perception, but the reality is they are 3 distinct, massive businesses all stacked under a single roof. When you look at the actual cash generation from 2025, SpaceX is primarily an internet service provider. Yeah, you heard that right. Their satellite broadband constellation, Starlink, accounts for a whopping 69% of their revenue. The rocket launching business, you know, the thing they are most famous for worldwide, only brings in about 13%. And then there is xAI, their artificial intelligence segment, sitting right there at 17.5%. And this brilliantly illustrates what happens next. When you follow the flow of that $18.7 billion in 2025 revenue, you quickly hit a massive wall of operating expenses. The reality of building space infrastructure and artificial intelligence from scratch is just incredibly capital intensive. Pushing against that amazing revenue is $11.8 billion in operating expenses. To put that into context, we are talking about an astronomical burn rate just to cover the raw costs of exotic aerospace materials, millions of gallons of rocket fuel, and of course retaining the absolute top tier of global engineering talent. That massive weight of research and development costs ultimately pulls their impressive top-line revenue down into an operating loss. Now, isolating these 3 segments reveals a really striking contrast in how the company actually functions financially. The connectivity segment, Starlink, is the true profit engine here. It's just churning out a massive $4.4 billion in operating profit in 2025. The space segment, the rockets, essentially breaks even, but what it does is provide SpaceX with a complete, virtually untouchable monopoly on cheap space launches. But then, you look down at the bottom. The AI segment is a massive $6.3 billion cash drain. It is bleeding capital at an absolutely incredible rate. Which brings us to Section 3, the AI moonshot gamble. Let's look closer at this. You really have to ask yourself, why would a space and internet company absorb such a massive money-losing AI division right before going public? Well, because this gamble is the true speculative catalyst behind that initial $1.77 trillion private valuation. The answer lies in a concept that sounds, frankly, completely wild: orbital data centers. Look, the single biggest bottleneck in the global AI build-out right now on Earth isn't just microchips, it's electricity and cooling. Terrestrial data centers consume billions of gallons of fresh water and require massive dedicated power plants just to keep the servers from melting down. SpaceX's completely sci-fi-esque plan is to use their massive Starship rockets to literally launch AI computing power into space. Up there, they have access to continuous, totally free solar energy and the ultimate, limitless cold sink for cooling, the vacuum of deep space. If they can actually pull this off, it bypasses the biggest terrestrial constraints in the entire tech world today. It is a wildly audacious engineering leap. But we have to look at the math behind this incredible gamble. In early 2026, SpaceX absorbed xAI in a $250 billion all-stock deal. That valued the AI firm at an astonishing 80 times its sales before the IPO roadshow even began. In SpaceX's pitch to investors, AI represents 93% of the company's total addressable market. Yet, and this is why this really matters to anyone watching this space, this entire valuation thesis relies on unproven deep space physics. Investors are essentially paying a premium for an incredibly ambitious AI destination priced as if it has already been finished, built, and completely conquered. And this is despite the fact that they are facing fierce competition from established tech giants and daunting, largely unsolved engineering challenges.
Moving to Section 4, priced for absolute perfection.
So, the crucial point is, this shifts our narrative from awe and wonder to a place of strict financial caution. With the stock trading at these extreme altitudes, we are looking at a massive valuation disconnect. We really have to ask a serious question here. Is this historic valuation actually a dangerous trap for retail investors? While the market happily pushed SpaceX's value to $2.1 trillion on day one, independent analysis from Morningstar pegs its actual fair value at closer to $780 billion. Morningstar issued a severe warning that the stock is trading at over 112 times its sales. At that multiple, the company is quite literally priced for absolute perfection. Think about it. If the company merely performs great over the next 5 years instead of perfectly, the stock price could easily collapse. There is zero room for error, zero room for delayed rocket launches, and absolutely zero room for failed AI experiments. Which brings us to a really fundamental concept in investing: the margin of safety. In a normal IPO, the investment bankers deliberately price the stock a little light, a little under its maximum perceived value. That slight underpricing is the buyer's cushion. It protects you if things go slightly wrong down the road. But SpaceX? They completely bypass that traditional model. They set a take-it-or-leave-it flat price of $135 a share before the roadshow even began. This kind of move is incredibly rare on Wall Street, and it really showcases the immense, unprecedented leverage SpaceX had over the big banks and institutional investors. By design, they intentionally removed any buyer's cushion. You are paying for all of the potential future success entirely upfront. It really brings to mind the legendary, slightly wry wisdom of Benjamin Graham, the famous mentor to Warren Buffett. He once quipped that IPO doesn't just stand for initial public offering, it also stands for it's probably overpriced, imaginary profits only, or insider's private opportunity. Graham's timeless point is that IPOs are inherently structured, timed, and precisely priced to maximize the benefit for the seller, the insiders who built the company, not for the everyday retail buyer eagerly jumping in on day one. And finally, Section 5, red flags and hidden risks. Let's unpack the really crucial stuff. Because when you dig past the headlines, the amazing rocket catches, and the trillionaire milestones, you start to see the structural and governance traps lurking just beneath the surface of all this media hype. Let's walk deliberately through what market analysts are calling the thin float trap, because this explains the exact mechanics behind that massive day one pop. Okay, step 1. SpaceX only offered a tiny percentage of its shares to the public, a razor-thin float. Step 2, because the initial market cap was so astronomically huge, Nasdaq's fast entry rule was triggered. This forced giant index funds to buy the stock almost immediately.
And remember, index funds are blind buyers. They must buy the stock to mirror the index, regardless of whether the price actually makes sense. Step 3, this blind mechanical demand fiercely chased a tiny supply of tradable shares, artificially pumping the price up to that $2.1 trillion mark. But step 4, well, that is the real danger zone. When insider lockup periods expire and employees eventually start selling their shares, vast new supply will suddenly flood the market. That day one pop was a structural market anomaly, not necessarily a true, rational verdict on the company's fundamental value.
And the reality of the balance sheet demands some careful attention too. SpaceX posted a $4.9 billion net loss in 2025, heavily dragged down by their new AI division. On top of that, they have a staggering, jaw-dropping $20.7 billion annual cash burn rate. Just let that number sink in for a moment. $20.7 billion. Furthermore, as a point of governance, Elon Musk retains about 85% voting control over the newly public entity. This means that minority shareholders have absolutely zero say in company governance, board decisions, or strategic pivots. You're just along for the ride. And critically, they have a $20 billion bridge loan hanging over the balance sheet that matures just 15 months after this IPO. They are heavily leveraged on the immediate success of their AI ambitions.
So after all of that, it really leaves us with the ultimate question. Is SpaceX a great company or a great investment? Because as we've explored today in this explainer, those are two very, very different things. The technological achievements here are genuinely breathtaking. I mean, they've literally built the foundational railroad to space, and they completely dominate global satellite internet. But the cold, hard reality of a stock priced over 100 times its sales, heavily reliant on completely unproven orbital data centers with absolutely zero margin of safety, that requires a deeply careful, thoughtful approach. Is paying tomorrow's perfect price for today's promise a visionary move or an incredible risk? That's the fascinating question every single investor has to answer for themselves.